Our next guest offers a contrasting view. He sees the Central and Eastern European region as a prime destination for foreign investment and growth. David Hauner is head of emerging market Middle East Africa economics at Bank of America Securities Merrill Lynch. He's also a former economist at the IMF, and he is joining us now from London. David, glad to have you with us. We assume that you like parts of this region if you choose carefully. Is that right?
Yes, that's right. We think that it's true that emerging Europe, Middle East and Africa, and particularly the European countries, face a lot of challenges these days. But they are clearly going to grow again sometime in the future. We think that some of the countries, like Turkey, for example, might actually even see a growth acceleration if you look at it in the longer term.
Okay. Timing is everything, David, as in all. I mean, when do you see growth?
Well, we actually see growth in some of the better positioned countries already resuming in the latter part of this year. And for 2010, we expect that some of the countries can actually grow at a rate of about 3%. That is Turkey and South Africa. Some of the other Middle Eastern countries are also well placed. Clearly, the countries in Central Eastern Europe and Russia are in a bit more trouble.
I want to get you back, if you don't mind, to sort of Central Europe because you're highlighting Turkey, but we've heard a lot of news flow, negative news flow from Eastern Europe. And in fact, yesterday we had Nouriel Roubini on with us right here on Bloomberg Television talking about the banks in the region, that some projected losses as high as $10 billion. Is that too high? Is that not high enough? And how does that change your view towards investing in Turkey, for example?
Well, we actually think that the banks in Central and Eastern Europe might face losses higher than that. But if you put it in the overall picture, if you think about how large the losses are in Western Europe, and if you compare even these 10, 20, 30 billions of dollars that we're looking at in Central and Eastern Europe to the GDP of these countries and to the size of the banking systems, these numbers become clearly much less scary. Also, we have seen over the last several months the Western European banks, which dominate really the banking systems in Central and Eastern Europe, a lot of Austrian, Italian banks in Poland, Hungary and so on, have been actually staying on the ground and have been supporting their subsidiaries there.
Can you draw any parallels, sort of a worst-case scenario as what we saw in Iceland, for example, a few months ago, meaning that the banking system was such a large part proportionally to GDP that's part of what caused that financial meltdown?
No, in Central Eastern Europe, there's really no country that can parallel Iceland. There are some countries where the risk is really high, and that are the Baltics, so Estonia, Latvia, Lithuania. But we think that even there, with the help of the IMF and the EU, things should be under control. Let's bear in mind that in Iceland, really, the problems were exceptional, and also the solution was actually delayed very long. While in these Baltic countries, the IMF is already on the ground, and the European Union has a lot of money to help them. Let's also bear in mind they are really tiny.
You mentioned Latvia. I just want to ask you, on a scale of 1 to 10, how likely is it that we see a currency crisis there?
Well, we need to distinguish here. We don't expect a currency crisis, but we think that it is quite possible that the government will ultimately decide to devalue the currency. And our official call here is that the probability is 60%. But we expect this to be an orderly process with the help of the IMF and the EU. We don't expect a crisis in that sense.
All right, David, we thank you very much. David Hauner there joining us from Bank of America Merrill Lynch.